Private equity refers to investments made in private companies or assets that are not publicly traded on stock exchanges. Private equity firms raise capital from institutional investors, high net worth individuals, and other sources to invest in privately held businesses. The goal of private equity investing is typically to achieve capital appreciation by actively managing and growing the companies in which they invest. Private equity can take various forms, including venture capital, buyouts, and growth equity. Here's an overview of how private equity invests in private companies. 1. Fundraising. Private equity firms raise funds from institutional investors, such as pension funds, endowments, and sovereign wealth funds, as well as from high net worth individuals. These funds form a pool of capital that the private equity firm can deploy for investments. 2. Fund structure. Private equity funds are typically structured as limited partnerships, where the private equity firm acts as the general partner responsible for managing the fund, and the investors act as limited partners. 3. Investment focus. Private equity investments can be categorized into different strategies based on the stage and nature of the investments. Common strategies include venture capital, investing in early-stage companies, often startups, with high growth potential. Buyouts, acquiring a controlling stake in established companies with the aim of improving operations, increasing efficiency, and eventually selling the company for a profit. Growth equity, providing capital to companies that have already demonstrated a level of success and are looking to expand further. 4. Deal sourcing. Private equity firms actively seek investment opportunities through various channels, including networking, industry relationships, proprietary research, and deal intermediaries. They may also engage in competitive bidding processes to acquire companies. 5. Due diligence. Before making an investment, private equity firms conduct thorough due diligence on potential target companies. This process involves evaluating the company's financial health, management team, market position, growth prospects, and potential risks. 6. Deal structuring. Once a potential investment is identified, private equity firms negotiate the terms of the deal, including the purchase price, ownership stake, and the structure of the investment. The goal is to structure a deal that aligns with the private equity firm's investment thesis. 7. Active management. After acquiring a stake in a private company, private equity firms take an active role in the management and operations of the business. This may involve implementing strategic initiatives, improving operational efficiency, and providing guidance on key decisions. 8. Value creation. Private equity firms aim to create value in their portfolio companies through various means, including operational improvements, cost reduction, expansion into new markets, and strategic acquisitions. 9. Exit strategies. Private equity firms typically have a predefined exit strategy. Common exit options include selling the portfolio company to another strategic buyer, conducting an initial public offering, IPO, or selling to another private equity firm. 10. Return on investment. The success of a private equity investment is measured by the return on investment achieved upon exiting the investment. Private equity firms aim to generate substantial returns for their investors, often outperforming public market investments. 11. Fund life cycle. Private equity funds have a limited life cycle, usually ranging from 7 to 10 years. During this period, the private equity firm makes investments, actively manages portfolio companies, and exits investments to return capital to investors. Private equity investing involves a higher level of active involvement and risk compared to investing in publicly traded securities. It requires specialized skills in deal sourcing, due diligence, operational management, and strategic decision-making. Private equity firms play a crucial role in fostering innovation, driving growth, and providing capital to companies that may not have access to public markets.